The financial markets are sending a powerful message. Anticipation is running high for U.S. Federal Reserve interest rate cuts, and the world is watching to see just how far-reaching their impact will be. Could this be the turning point investors have been holding out for? Or are we about to witness market dynamics no one predicted? Let's break down the story. Spoiler alert, there's more excitement and debate than meets the eye. First, consider the scene. Global stock markets look poised to notch up a healthy gain for the week, propelled by the widespread belief that the Fed is readying a series of rapid rate cuts. The promise of cheaper borrowing isn't just good news for equity investors. It's a much-needed relief for stressed bonds and a reason for the US dollar to lose some of its shine. On Friday, European shares eased 0.1%. While futures for both the Nasdaq and S&P 500 remained flat or slightly down after Wall Street indexes set new all-time highs overnight. While the major European index nudged lower, the MSCI All-Country World Index is on track for a 1.8% gain this week, confirming that investor optimism isn't limited to one region. But here's where it gets even more interesting. Gold prices are surging, nearing historic highs and closing in on a fourth straight week of gains. That signals that, despite the upbeat mood among equity investors, there are still undercurrents of caution. Recent moves suggest that many still worry about the future of the global economy. But look at Asia for a twist. Stock markets across the region kicked off Friday with robust gains, and Chinese shares soared to their highest levels in over 3 years. What's fueling that rally? Distinctly bold expectations around profits from artificial intelligence, a trend that's stirring up plenty of excitement and skepticism among traders. What about the data driving all this? The latest U.S. consumer price report revealed a bump in inflation. However, investors didn't flinch. Their focus remained instead on the soft job market data that had come out the week prior. And this is the part most people miss. Even with weaker employment figures, market participants seem convinced that the Fed's anticipated cuts will reignite growth in coming months. As Amélie de Rambier, a senior multi-asset portfolio manager at Amundi, put it, weaker job numbers haven't shaken investors' faith in the Fed's market-boosting power. Adding to the mix, Citi economist Veronica Clark forecasts that the central bank could slice as much as 125 basis points off rates over its next 5 meetings, an aggressive move if realized. Futures trading suggests a virtually unanimous expectation of at least a quarter-point rate cut soon, with a slim chance of a more significant half-point cut. For bond watchers, yields on the 10-year U.S. Treasury rose slightly but remained down from earlier in the week, demonstrating just how sensitive debt markets are to every policy signal. But it's not just U.S. policymakers shaping the landscape. In Europe, the central bank decided to leave interest rates untouched, declaring that policy is in a good place. This has prompted some economists, like J.P. Morgan's Greg Fusesi, to predict that the next potential rate cut now moves from October to December, unless, of course, an unexpectedly large economic shock hits. ECB insiders point to December as the most probable moment for further easing. But current market pricing suggests only a small chance such action will be taken. Meanwhile, economic growth in Britain flatlined in July, exactly as predicted, but with a jarring slump in factory activity. The result? The British pound slipped ever so slightly, adding to uncertainty among traders focused on the UK's economic prospects. Commodity traders are also busy. Gold firmed up by 0.5%, approaching its all-time peak as investors kept seeking safe havens amidst swirling uncertainty. Oil markets, too, climbed higher, defying predictions from the International Energy Agency that a historic surplus could build next year as OPEC pumps more crude. Brent crude and U.S. oil both registered solid gains by the end of Friday's session. All in all, this is a market environment where expectations, fears, and hopes collide. Are the Fed's expected cuts a needed dose of medicine that will revive global growth? Or could they stoke inflation and asset bubbles down the line? Is gold's rally a warning alarm or an overreaction? And will the AI-fueled stock rallies in China prove justified? Or are we witnessing another speculative bubble in the making? This is a moment of monumental change, and not everyone agrees on what comes next. What's your take? Are these policy moves helping or hurting long-term stability? Do you see opportunity, risk, or a bit of both? Jump into the comments and share your thoughts, especially if you think the experts are missing something.